Sean, I mean, what are you making of the messaging coming out of both these central banks here as well, at times when you've got a different economic climate as well in both of them?
Yeah, look, it's hawkish from both. I mean, let's take the Fed first. There's no chance of a pivot. The market is predicting a pivot. The market in the last 24 hours is even saying, there should be a cut in July, but that's clearly not happening in Fed speak. And there lies the danger, because with the banking issues and the US debt issue, and we probably will have a recession at some point in the US, and the Fed probably will not cut into it. It will be too late. In Europe, it's different. As Kathleen said, they're late. And why they were late is because Europe was looking like recession at the beginning of the year because of the energy situation. But Europe now looks like it's going to grow more than the US, and it won't go into recession. So it is sensible then to raise rates. But I think that. Yeah, so I think the implications are probably European equities have probably got more upside against, and also the euro as well.
Absolutely. You look at the bond market, we were talking about this earlier, it's telling a story that they don't believe the Federal Reserve, and we're looking here at some market participants suggesting that you have to start worrying when the inverted yield curve starts re-steepening.
Absolutely. I think, look, I think the other thing to point out is financial conditions are actually still quite loose. I mean, since the banking issues have started, the Fed has basically unwound 6 months of QT. Yep. And that's got to start again. And so yeah, there's a lot of risk out there, and I think the US equity market is probably priced too much for perfection. I mean, you look at the risks you're talking about, and the market's up.
Sean, we've seen the Fed do about 500 in the course of about a year and a bit. And as you said, QT is progressing. Are we about to see the full impact of this rate hiking cycle? And how might that play out? How will it look like?
I think it will take time to play out. I think they won't do. I mean, QT is on pause. I think the banking situation's more, put a pause to that. I would see the delta really being in expectations now on inflation relative to what the Fed being on pause and the market thinking there's going to be a pivot. And I think that makes quite a big difference to valuations as well, because a lot of equity markets, particularly the tech sector in the US, has done well because people thought rates were going to come down. But our view is clearly rates will not come down in the US this year.
Of course, the bank failure is front and center. Markets back worrying about a potential contagion. But the Fed says, you know what, we have this under control. Do you believe the Fed?
It seems like it's going from one bank to the other, and just the next weakest bank along has been targeted, in my view. Look, I mean, the Fed can guarantee. I don't think any of the situations are going to be as bad as they were in the first couple of banks, but I mean, they're getting bigger. So yeah, it is a serious issue. I mean, it's good news for the larger banks who are getting all the deposits in, but it's a very narrow issue, and it must be worrying because it's going to stop them tightening. It's going to stop them doing QT, which really they need to reduce the balance sheet.
Sure. I mean, if inflation has peaked in the US, should we be raising rates after it's peaked? Because even Paul Volcker, who's Jay Powell's hero in many ways and carries his book around when he first came to the Fed, even he, in 1980, 1981, stopped hiking rates 2 months before inflation peaked.
Absolutely. I mean, this lag has just...
I mean, are they digging? If you are digging a hole, stop digging.
Well, I'm surprised that they carried on, given the banking issue. They should have paused. But I suppose their issue is they're looking at the inflation rate, and the inflation rate is coming down, but it's not coming down quick enough. And, you're even seeing second-hand cars going up. The labour market's really interesting, because I think there's a structural issue here. We've always talked about this. It's not about, unemployment. A lot of people don't want to go back to work, and it's not in the tech sector, which is quite narrow. It's in services. People are going back for part-time work. But I think the real interesting chart that hasn't been put up for a while is the level of the household balance sheet. And, a year or so ago, given all the money that was given to people during the COVID crisis, the balance sheet was 1.5 times what it was pre-COVID. That's now completely eroded. And that's worrying, because if the consumer stops spending, if that sort of revenge spending is gone, then I think we are, then they have over-tightened. And that will really impact the economy and earnings quite quickly.